There are a lot of pitfalls in trading, and it's really only a matter of time before one of them starts to challenge you in ways that you could not imagine. And traders often hear about trading psychology and how important it is to understand how issues with psychology can influence your trading results. Make no mistake that with a few exceptions, the psychological aspects of trading are what do most traders in, assuming the trader is using a positive expectancy trading system. Along with a positive expectancy system, traders must have a trading plan that outlines every aspect of what makes up a trading opportunity. And it sounds simple. You just follow the plan. But anybody who tackles trading is going to find that this is not as easy as it appears. And one thing that dogged me in my early years of trading, it still does at times, is the entire leaving money on the table. And that's where you take your profits at certain levels, and the market just continues to go in the direction that you're trading in. And as you watch the price move, you are calculating in your head how much your account would have grown if you'd only let it ride instead of snatching at the profits that were available. And many trading methods and systems, they have profit targets. And it could be a percentage of the average true range, a support and resistance level, or even a simple trendline break. Once the level's hit, you exit, bank the profits. And some systems will use these targets as places to manage the risk you have in the market. And we all look to minimize risk, knowing that we cannot fully escape risk when we have an active trade on. When you exit out of the market, you are no longer at risk, right? Well, yes and no. Financially, there's no risk. But mentally, that's an entirely different story. When you watch the market pull away, it leaves you looking at your small but consistent gain, but you're calculating how much money you left on the table. And for many people, this will cause them to rethink how are they going to handle their exits in the trading. So let's assume that profit targets set in your system and they're not entirely random. All right, they're calculated through the moves of the market and they're objective and they're using such things as a measured move. Having these zones have the plus of keeping you consistent. Consistency in everything we do in trading can never be overstated. The risk comes when you see how much you are leaving on the table and you decide to alter your trading plan. The next trading day, you're determined to grab that extended move and you trail a portion of your position. But worse, you decide to ignore the profit target and you choose to trail the whole thing. Well, the problem is that every day in the market's unique. And this day, the day that you change your trade plan on the fly, the market's not moving as well. Price heads towards your objective profit target, but instead of exiting, you just trail it. And the market reverses and takes you out. Worse, price did not go far enough to trail it. So your original stop loss is now hit because you ignored the adverse price action that was against you. You realize that changing your plan on the fly, it's not good practice. So you return to the original plan where you found steady results. So the following day, you choose to exit at your target. But of course, this is going to be a trend day. The market exceeds your target, and it was a great one to trail. So you kick yourself and you decide the next trade will be a let your profits run trade. And of course, the next trade does not move like the first one. So a feedback loop begins, and it's not long before you are off track, and the consistency and results that you once had are gone. Knee-jerk reactions has caused you to lose one of the most important traits that a trader can have: consistency. Believe that once this wheel comes off that wagon, the others are going to follow. Look, you're going to miss trades. And perhaps these moves, they fall outside of your trading time frame, or they don't suit your setup according to your plan. These trades, they're going to rocket away and give those that are in the market a really nice win. But you can't be in every move of the market, and you have to accept that. Accept that you will not only miss huge runs, but you'll also exit trades that will go on huge runs. The fact is that taking your profit targets consistently already puts you on the right side of being a winning trader. Most who enter the trading world end up losing, and most don't follow any type of trading plan or a set trading strategy. Sticking to what is consistent and banking those targets when reached is following a plan. Following a trading plan will keep you out of the risk of deviating due to market events. You are trading a winning plan. Be happy with that and make your goal all about compounding. Take your quick hits and allow your account to grow consistently. Then those profit target winners, they'll become larger simply by increasing your position size. Leaving money on the table will no longer be an issue because the money you do take off the table is substantial.